All right, so welcome back to another episode of Finding Value Stocks. So I told you in the last episode that I was going to listen to the MFA Financial earnings call and see if I found anything that I liked or didn't like. So after we looked at the numbers in the spreadsheet, I just always go back and read the earnings calls, transcripts, or listen and look at their investor presentations and see if there's anything that stands out. So I went back and looked at two earnings calls. I looked at Q4 of 2020 and Q1 of 2021, which is the latest, came out in May. So just to go back in time and come forward. So in Q4, they said they're seeing a strong housing market and that they purchased 14 million shares of their own in a repurchase program. They're looking to repurchase up to $250 million worth of shares. So they repurchased 14 million out of 395 million shares outstanding. So they're less than half. Right now, they're less than halfway done with the buyback program. So that's still supporting the stock. They're repurchasing the stock well below book value back then, around 60% of book value, and they're positioning themselves to thrive in the future. By locking in a low-cost, non-recourse debt to lower their interest expense in the future. They also, back then, a big deal was delinquent loans. So they said delinquent loans have a high enough loan-to-value ratio that if the person becomes too far behind on their loan, that they can just sell the property. And because real estate prices are so high right now, usually they're not underwater on the loan, so they have enough to pay off the loan. So they're not losing money there. They're noticing strict loan standards for income. Which I saw in another person's video that income and mortgage standards are around the 2013 level, which is still pretty strict. So they had earnings of 8 cents per share and they paid out 7.5 cents in dividends. So that was good. And so they still have, back then they still had some coverage ratio. And in the next one, we're going to see that they had a lot of coverage. And so hopefully they're going to increase the dividends soon. It used to be 20 cents per quarter. Right now it's 7.5 cents. So they also sold 1,000 real estate REO properties, so real estate owned properties, which means they took the property back from the person who borrowed to buy the property. So they sold 1,000 of those, and for an average of 105.9% of the carrying value of the loan. So they generated some income of $15 million on that. So that was all the stuff I noted for that quarter. For the latest quarter, first quarter of 2021, they're optimistic about a return to normalcy. And it also, they said in the call that they're back in the office. So I thought that was good, that they're able to, talk to each other in person. So they had a GAAP book value of $4.63 and an economic book value of $5.09, which are both above the current share price of $4.55. They repurchased 10 million shares at an average price of $4.14. So we can see that's, where they're still willing to repurchase their own shares. But they did say that now that they're around 80% book value at $4.14, that they were a little less happy about purchasing at that high of a cost because they can put that money to better use elsewhere. They liquidated another 177 REO properties, generating $2.2 million of earnings on those. They also opened up their share repurchase window of when they're able to repurchase shares. So it seems like they were restricted to a certain amount of time after the earnings date release, but now they have a more open window. And another big thing that they talked about during this call was that they acquired NEMA 1 Holdings. So this is an originator of business purpose loans. So they loan out hard money for fix and flip investment properties, rental properties, and multifamily properties. And previously they had a 42% stake in this company, and now they are buying the whole thing. And they think it's going to add 8 to 10 cents per share per year in earnings. So hopefully that's more dividends they can pay out. In the past, they're pretty confident about buying this company because in the past they've purchased $1 billion in loans from them since 2017, and they purchased their operating platform and $1 billion servicing book. Right now they're changing from measuring their loans in fair value to carrying value. they're changing from fair value to carrying value. I need to go check. It might be the other way around. But because of that, they're changing to fair value from carrying value. And because of that, they're reporting GAAP and economic value until they get rid of their carrying value loans. Prepayment speeds increasing as mortgage rates coming down. So people are refinancing their existing home loans, and also they're selling their loans and moving to other houses. They expect to continue to issue securitized, they expect to continue being a programmatic issuer of securitization as it continues to be the most efficient form of financing their portfolio, is what they said. They also said that 7 cents out of 17 cents of earnings they reported in the quarter were from basically unusual activity that made them money. So we can even take that away and say, okay, but what if they only made 10 cents that quarter? They still only paid 7.5 cents in dividends. So that's still a huge coverage ratio. So that's not a positive for the stock. So it's below book value at 89%. They're paying a high dividend of 8.77%, and they have a great coverage ratio. So hopefully all that's positive for the share price and for dividend hikes in the future. So overall, I didn't find anything that worried me. I actually liked it. I thought their earnings calls were positive, considering the environment, and they're making acquisitions, and it seems like they're trying to grow. So those are all great things. The only thing I'm still a little bit worried about trying to figure out is, what happens right now. There's really low interest rates. The housing market is really hot. So what happens if that starts to stabilize or go the other way, where people are buying less houses? But even still, I think we're going to be okay. Let's say there's even more lockdowns. That just means people are in their house more. So now people want a bigger house. Or if they're in an apartment, they want to move to a house so they have more space. So that's still good for the housing market. So I don't think, even if housing prices starting to flatten or come down, I still think the demand for home loans is going to be strong. It seems like nothing can turn that demand off. So we'll see. Since lending standards have remained strict, I don't think we're going to see any craziness like we saw in 2008, where people couldn't repay. But we'll see. Overall, I like the stock. So make sure you hit the subscribe button, comment, hit the like button, let me know, and I'll see you on the next video.